Welcome back to What the Halo. I'm your host, Dave Townsend, joined today by Ray Denis and Jason Barsema. Thanks, guys, for joining the show.
Thank you for
Good
having
to
us.
be here.
Yeah, so we finally got this scheduled. You guys have been traveling a lot. So is summer is finally upon us, Jason. How's the golf game coming together?
I have no time for golf, David. You know that. All I do is work.
Okay, good answer. How about Ray? I was assuming the same.
Precisely. Exactly
Okay.
right.
All right. Well, so for those new to Ray and Sandbox, Ray, you want to give us a little bit about yourself?
Sure, yeah. So from the Boston area, ended up going to Notre Dame for school, graduated with a degree in American Studies, came back out east in 2006 to join Bear Stearns, which was a fortuitous time, obviously, to join that institution a couple years before the financial crisis, which wound up being a great thing for my career. I ended up overseeing about an $8 billion margin lending portfolio at the time and helped JP Morgan roll out their balance sheet products to the Bear Stearns client base on the high net worth side of the business. So that included rolling out deposits and mortgages and art loans and aircraft loans, all sorts of different liquidity and hedging products. And ultimately, throughout my Wall Street career, I'd done the same thing at various institutions. And last year, a couple of years ago, decided to found Sandbox, which we'll get into quite a bit. But eager to be here and glad to chat with you guys.
Yeah. Hey, Jason, before because I want to, for those new, I want you to give a little bit about yourself, but this is a special episode in the sense that, Ray, although you're a Notre Dame guy, it's unusual that Ohio State and Jason's alma mater, Northern Illinois, would beat Notre Dame in the same season. So I'm a Buckeye. I didn't tell you this beforehand. So
Wow.
Jason went to the game. I obviously didn't make the
I
national
was on the
championship.
sideline, but it was a great day for NIU. I think it was a better season for Notre Dame, as we did not get to the championship, but no, it was a great moment.
Yeah. Hey, Jason, give us a little bit about yourself.
Yes, I'm the co-founder and president of Halo. Prior to founding the company in 2015, I spent my career at Credit Suisse on the private banking side. So for many of those who know me, you know that I have sat in your seat. And so I manage portfolios for ultra high net worth individuals, institutions, and family offices. Soup to nuts portfolios, but structured products were a very important part of my asset allocations. Roughly 20% of my portfolios were dedicated to the product. And really, the genesis of founding Halo was about not only solving a lot of the product problems that I had in regards to fees, liquidity, transparency, complexity, but most importantly, it was really about democratizing the product and allowing all investors to be able to have this bridge between that risk gap of stocks and bonds. We launched a platform live in 2017, and the rest was history. It's been a blessing. We've gone from transacting 35 million dollars a year when I first started to last year we processed about 15.3 billion dollars in that span, and as you know, David, we've been named in the top 10 most innovative fintechs 2 years in a row.
Yep. Yeah. And Ray, your story isn't that all that different in terms of founding and launching Sandbox and trying to bring sophisticated, maybe institutional strength capabilities to the everyday investor. Give us a little bit more about Sandbox, why you founded it, and a little bit behind the story.
Yeah, so I spent 20 years on Wall Street, roughly, delivering liquidity and hedging products to high net worth and ultra high net worth individuals, and noticed two major trends that led me to found Sandbox. One being the sort of proliferation of independent advisory firms, whether it's RIAs, family offices, trust companies, insurance carriers getting into the wealth business, et cetera. Roughly $10 trillion of assets are managed by these institutions today, and they don't have banks, right? So we're looking to fill the void that's created when a lot of advisors go independent or when clients decide to work with boutiques or independent firms where they can't access a lot of the liquidity and hedging products that private banks and wirehouses use to deepen their best relationships and drive organic growth. So that proliferation of independent advisory firms was part of our thesis. There was an opportunity there that we saw. The second thing that we also saw was sort of the product opportunity. Having underwritten many billions of dollars of debt at these larger institutions, you recognize that the process can be somewhat manual. You're ingesting data from clients in the form of personal balance sheets and tax returns, and there's an army of analysts and spreadsheets that are essentially cobbling together risk rating models. And I felt that there was an opportunity, given all the latest advancements in AI and open finance to aggregate data on behalf of clients and really streamline the underwriting and origination process for lenders. So you sort of combine that market opportunity with the product opportunity to really streamline workflows. And I felt like there was a business there. And over the last couple of years, we've seen that play itself out in the form of this relationship with Halo is an example, but broader opportunities that we're seeing in the marketplace where we see these independent firms really want to deepen their relationships, and they're seeing banking and lending as being an opportunity to do that. So that was, again, the genesis behind Sandbox. We've seen rapid adoption of the model in terms of delivering these solutions, and we're excited to sort of see where this takes us over the next several years as more advisors go independent and more assets flow along with them.
Well,
Yeah,
I think that's
Jason.
I mean, just to add there,
Yeah.
that's exactly the point, right? Is when we founded Halo, we saw a great opportunity in the independent space. And it's not just the independent RIA, it's the independent broker dealer, the independent custodian, the middle market private bank, where ultimately, as investors, we all have the same needs, right? And we all ultimately need to grow our wealth at a reasonable rate of return. We need to be able to preserve our wealth, and we need to generate a level of income to do that. But we also need more advanced practice or advanced wealth solutions like lending. So really our thesis from Halo was, yes, this independent space has always been our core market, and we've done a very good job within that market, but we need to go further. And that's why Halo is not just about structured products. It's about annuities. It's about SMAs. It's about concentrated stock positions, wrapping these advanced wealth solutions around it like Sandbox. So now you can get that private banking experience without having to be a private banker. And I think all investors deserve that right.
Yeah. Ray, I know you mentioned the breakaway advisor, and I know that's not, you know, necessarily the only thing you focus on. But when you think about the breakaway advisor, leaving the classic wirehouses, private banks, and the like, who have obviously advanced cash management, treasury solutions. When you think about the everyday advisor, if you will, breaking away and so forth, how are cash management solutions so important?
Yeah, there's two ways to look at it. One being on the asset side of the ledger and one being on the liability side. So when you think about cash, people just traditionally think about the asset side. So they think checking accounts and savings accounts or sweep accounts, et cetera. And that's part of our thesis is there's an opportunity there to offer things like operating cash accounts, sweep fund access and potentially longer term, short duration, fixed income type solutions through the platform so people can manage all of their liquidity on Sandbox on the asset side of it. But what we're focusing on today is primarily around the lending side of the equation, which is giving people the flexibility to sell assets when they want to and not when they have to, right? So by
Yeah.
virtue of being able to borrow against a portfolio of securities, you now are essentially having that option on liquidity. You could either borrow to fund that liquidity need, whether it's a tax bill or a real estate purchase or an opportunistic investment, or you could sell, right? If it's the right time to sell the asset, you can go ahead and do that too. And you want to give people that flexibility primarily by virtue of borrowing against those assets.
Yeah, Jason, obviously, structured products, structured notes is one of your Halo's bread and butter solutions. When you think about as you've deepened the relationship with Sandbox, how do structured note investors benefit?
Well, at the end of the day, lending on structured products is nothing new. It's been around for many different years. It was a very important part of my practice at Credit Suisse, and we used
Okay.
to borrow against structured products for a number of reasons. As Ray mentioned, sometimes you want to buy a house, sometimes you want a boat. You got to put the kids through college. There's a variety of reasons of why we use the proverbial credit card, but there's also tactical reasons of why people borrow against their structured products. And for us, it was really around the alternative investments that we use. So, we would make commitments to private equity funds where you would commit $1 million, $5 million, $10 million, whatever the number is. And most of those private equity funds call 50% of that capital up front, and then they'll call the remaining 50%, if they call at all, over the next 1, 2, 3 years. And what you don't want to do is that you don't want to just sit in cash for the remaining uncalled parts. So what we used to do is saying, look, we like the exposure of these income structured notes anyways. Why don't we go and buy income structured notes with really, large protection amounts? So super deep barriers, if you will, say 40, 50%, where we're going to derive some more yield over a traditional corporate bond portfolio. And then ultimately, when that private equity fund calls that capital, I can borrow off of that structured note to fund the capital call. while still being able to generate the yield that I want within my portfolios, and then wait for that note to get called or matured within my portfolio. It was a very elegant solution for me. It was a way for me to be able to derive more yield and return within the portfolios. But at the end of the day, right, what's the thesis? The thesis is that we all demand liquidity on our assets, right? And I know you've seen the proliferation of alternatives, but what's really nice about structured notes is that there is daily liquidity, and that's awesome. However, there's a lot of times that I don't want to sell my structured note because I like the terms. Maybe you bought a really juicy income note during COVID or during 2022 or during the GFC where you are getting investment terms, meaning yield or upside and or protection that you'll never see again, or it'll take you 5 to 10 years to see.
Yeah.
You may not want to sell that note to generate liquidity. So Sandbox and Halo together gives you another way to be able to generate liquidity other than just having to sell your note. And I'll give you a live example of this. We had a client who ultimately needed to come up with about $100 million of liquidity to receive $120 million back. It was a very complicated situation. Now, at the time, and this was 3 or 4 years ago, they wanted to be able to borrow off their structured notes. They could when this advisor was at a wirehouse. Now the advisor is at Schwab, and there was no solution to be able to borrow off of your structured notes. And it was really heartbreaking because that advisor held these income notes that with really attractive yields that would take you, again, a very long time to be able to achieve again. So instead of being able to borrow off of that portfolio to fund that $100 million, right? And then paid off when he got his 120, we had to sell that entire portfolio. And it was heartbreaking because then ultimately they went up and bought those structured notes again and at yields that were half of what they owned. So think about liquidity as not just what's the liquidity on the product itself, meaning can I buy or sell at any given day? Think about it as also as the ability to borrow against the position. And so this is super novel in the independent space. The second thing I'll say is that if you're a wirehouse advisor or a private banking advisor like me that had a lot of lending in general across my portfolios, it's very difficult for me to move. I was at Credit Suisse, as I mentioned, for me to move from Credit Suisse to be independent, even if it's the right thing for my clients, because my clients may not have the liquidity to pay off those lines of credit to Credit Suisse, only to put them on again at Schwab or Fidelity or at whatever custodian you use. So Sandbox is a really elegant solution because you're able to get that independent financing that will allow you to move your practice instead of being, wrapped around these tentacles of lending that the private banks use and use for right reasons, right? It's a way to keep assets sticky. This allows people to be a lot more independent.
Yeah, you mentioned the proliferation of structured notes and more generally just the proliferation of like alternative investments, things beyond stocks and bonds, which have been classically much easier to lend against. So Ray, I mean, you're having so many conversations every day, and every day we see a new article about how 401ks are now going to have alternative investments, and what I'm trying to say is like these things are becoming mainstream core parts of a portfolio. So Ray, your timing is somewhat perfect in terms of like obviously there's just going to need more cash solutions to manage the more intricacies of modern portfolio management. So in terms of the growth, where do you see things in 5 years from now?
Yeah, well, I mean, I obviously see the same thing you guys see, which is this, proliferation of private investments, of structured notes, of bespoke investment solutions more broadly. And what our lending partners are now sort of, becoming aware of is that this is the data, sort of solution that we need to build, right? Because you need that transparency into the asset in order to get comfortable with lending against it. And so the growth that we're going to see is going to be data driven. And so our platform at its core becomes a data platform, right? So we aggregate data from all the various custodians, and we work with Halo to ingest data on term sheets that are related to the structured notes that are issued through the marketplace. We work with other investment firms that provide us with data on things like private investments or artwork, et cetera. So as we start to become this data platform, we provide lenders with a little bit more comfort around their ability to sell an asset in the unfortunate circumstance of a foreclosure. So that's where I think we're headed is sort of this data play becoming more and more important around alternatives and structured notes and other esoteric assets, because ultimately the lender is going to need access to that data. And we're fortunate to have a network of lenders that we work with. So we're not a lender ourselves. And
Yeah.
as we sort of see this migration towards independence as being part of the business model, lenders are really keen to recapture a lot of that activity that is resulting from advisors leaving their institutions. And we're seeing that interest level from tier one institutions to finance a lot of these assets because they see the opportunity across both the proliferation of independent advisors and this growth in private and esoteric investments.
Well, and a couple points of that too. What I think is really elegant about this Halo Sandbox solution is, again, putting my former Credit Suisse hat on. If David was my client and we were going to borrow against structured notes, stocks, bonds, whatever, is that I only have one source of that lending, right? One source of that liquidity, which is Credit Suisse. What I really like about Sandbox is, ultimately it's like a lending tree at the end of the day, right? To use a metaphor, is that I don't just have one potential lender, I've got multiple lenders who will compete for your business. So, Ray and I have a mutual client now that wants to borrow roughly $100 million off the portfolio, right, Ray? And we went out and they thought that they were getting really aggressive rates, and we were able to save them roughly 25 basis points on average on what they already thought was aggressive. So it goes into the whole point of Halo in general, is where we are a multi-issuer platform and multi-solution platform. This is a multi-lender platform. So it's very consonant with our brand and our mission and our message to bring in competition into a space that normally didn't have competition. Number two is that ultimately I feel like this is really good for the industry, because going back to an earlier point, is that people will tend to feel more comfortable to buy products that they very well may need within the portfolios, like structured notes to bridge that risk gap of stocks and bonds and add protection, or like other alternatives within the portfolios. And they may buy more now because they can actually have liquidity off of it. And so I really like this from a social perspective, because many times people would want to buy structured products, but they don't want to buy it because they have a certain lending need. And if you can't borrow against it, then they physically can't buy it. So now, again, we're providing that solution to be able to have investors and advisors have the protection that they want, demand, and deserve within their portfolios through lending.
Yeah. One of the quiet little pieces to this puzzle, if you will, is the idea of operational efficiency. So Ray, can you just walk us through what was the significance there? Because you can be sleepy, and I know you guys were actually quite excited by the idea of the operational efficiency now available by
Part.
exactly. Well, so I've sort of buried the lead here, but walk us through that.
Yeah, I mean, I've never been more into operational efficiency than being a founder of a company, where
Yeah.
every minute means that cash is flying out the door, right? And I think when you're at a larger institution, you might lose sight of that. And when you have all the resources in the world to underwrite and originate loans, you can just throw bodies at a problem, right? And solve a solution or build a platform that way. When you're a startup, you have to be a lot more efficient, not just operationally, but with how you allocate cash. And so every person that we have on the platform has to, or every person that we have at our firm needs to make things more efficient, right? In terms of how we operate. Meaning, if you're a developer, you're trying to, turn a lot of analyst roles into code, and ultimately making lenders more efficient, because a lot of the data that we're feeding lenders can now be used to accelerate their underwriting processes, internally in our sales processes, trying to find ways to get deals through the pipeline more quickly. So everything that we do is all about operational efficiency, right? Finding ways to save time, which ultimately will save not just us money, but also our clients and the borrowers that we work with capital, as well, as Jason alluded to on that one opportunity. So it's the centerpiece of what we're doing, right? It's to save time, where people can allocate more of their time, our clients' time, towards things that are revenue generating or more fulfilling, as opposed to working on banking and lending, which is our job.
Well, allow me to take a different aspect of that operational efficiency as well, because what Ray said is absolutely true. They make the process a lot easier for advisors to be able to get, lending on their investments. And it's not just structured products, right? So through Halo and Sandbox, we can provide you lending on equities, bonds, super vanilla everyday lending, structured notes, obviously, and in many cases, alternatives. But what I really liked about the operational efficiency was also in the RIA space, right? Is that a lot of RIAs have multiple custodians. And so the Barsema family might be having an account at Schwab and at Fidelity and at Pershing. And there's a variety of reasons of why that is. And one of those reasons is the lending capability of all of those custodians. So Fidelity may be better at lending against bonds or release rate or just the interest rate that they charge. Schwab may be better at equities. I'm not making a statement. I'm just using this as an example.
Sure, sure.
And so you're playing this like ball in the cup game, which is like, okay, well, I'm going to move Jason's bonds over to Fidelity and stocks over to Schwab. And then, oh, Fidelity just dropped their rate. So I'm moving that over. I'm always doing these ACATs. And that's really burdensome from the advisor and obviously from the client. I don't really want to have two custodians unless I can help it. And so what I really like about Sandbox's solution is that it sits above the custodians. And so what do I mean by that? You have one point of sale in regards to your lending needs. And then ultimately you can keep your assets wherever they're custodied. So you can keep three custodians if that's what you want. God bless. However, you don't have to keep on moving assets around to be able to maximize the rate. You've got one single line, one single rate with Sandbox, which makes it a heck of a lot easier when you're trying to manage your practice. And as we talked about earlier, ultimately we could help save you some money. What is kind of interesting about that is we have another client who we're onboarding onto Sandbox as we speak, where despite the rates, despite being able to lend against all structured notes. So you can lend against structured notes today, but the problem is many issuers will only lend against their credit because they want you to buy more of their credit, which I don't like. I think that's nutty. But we have been able to buy or being able to bring in lenders who will loan and lend against all of your structured products, regardless of their credit, and look at it through the lens of an entire portfolio. So with this particular advisor, they really liked that. They really liked the rate. But the thing that they liked the most was one single point of contact, one single line, because they were one of those firms that were constantly having to move assets around. So that was the most powerful message to a recent client of ours that we moved over to Sandbox.
Yep.
Yeah,
All
that
right.
really
Well,
comes down to this being a data solution, right? We want people to be able to see everything holistically on one platform, and that means advisors seeing everything holistically, clients seeing everything holistically, and lenders doing the same, right? So everybody's operating off the same data set, and that's where you really see those efficiencies come in.
well, it was great conversation, guys, and I really appreciate you finding some time here today. So we appreciate you. So viewers, please hit that like and subscribe button, and thanks, Ray, for joining us. When are you going to be in Chicago next?
Actually, in a couple weeks. I haven't told Jason yet, but I'll be out there the week of the 25th. I'll be
That's
there.
funny. I'll be in New York that week.
Oh, no
You
kidding.
guys across the paths.
Yeah. Well, from a sign-off perspective, right, is that this is a solution that we are very excited about. And as many of you know, we've got a number of different practice management solutions, whether it's lending, whether it's hedging and monetization, whether it's concentrated stock positions, whether it's annuities, SMAs, et cetera, et cetera. This has been one of the most popular and quickest passive adoption that we have seen of a solution that we've launched. And there's a reason why. There's a lot of really cool things that you can do with lending around your securities. And so with that is make sure that you contact and take the time to contact us. You can work through your current Halo representative. If you don't have one, go to haloinvesting.com. And then we will ultimately loop in Sandbox as we work as one team to be able to satisfy your lending needs.
All right. Well, thanks, guys. Jason, thanks for the sign off, and make sure you hit that like and subscribe button, Ray. I'm tracking.
Great.
Thank
Thanks,
you.
guys.
Take care.